Long end US 10 and credit spreads presentation. Today I'll be focusing on the Eurodollar to the Eurodollar outright futures, trading that against the 5-year future. So how do we create the longer end US TEDs? So the common name that I'm going to be talking all the way through is ED8 versus the 5-year, or we could also call it the 5-year US TED. So how do we construct it? We construct this by trading the 8th Eurodollar future. Now currently that's the June 18, so that's the June 18 Eurodollar future, and we trade that against the front month most liquid 5-year Treasury note future. Now this is called a credit spread because the Eurodollar future measures the cost of US dollar LIBOR rate, which is a rate amongst banks, to one another, and the 5-year Treasury note future is the rate at which the Federal Reserve can borrow 5-year US dollar. We're referring, when I'm going to be talking all the way through, but when I'm referring to buying the ED8 versus the 5-year or the 5-year TED, I'm actually referring to buying the Eurodollar June 2018 and selling the 5-year note future simultaneously. Conversely, when we are selling, we're selling the Eurodollar 8th versus the 5-year. So we're selling the Eurodollar 18 and buying the 5-year note future. So how do we create, again, this continuing on, how do we create these spreads? Now, they obviously have different tick sizes, they have different contract sizes. So using a DV01 ratio, which the actual real ratio is 10 to 4.8, as you know, you can't trade in decimals of a lot. So actually what we do is we round this to 2 to 1. I fully recommend starting live in 2 to 1 as a trade. Now, the ratio, we trade the ratio 2 of the Eurodollars against 1 of the 5-year note future, but we chart it 4 times the Eurodollar 2018 minus 1 of the 5-year note future. So initial clips, what I would do is expect the traders to start, or you to start trading in 2 to 1 with a max size of 10 by 5. Please note this is a synthetic spread, so you'll be trading 2 separate outrights creating this spread. This is not an outright trade. The opportunity and the risk is in the direction of the spread itself, and that is the opportunity we're looking to capture. So what I like to do in all the spreads that I trade, I like to look at the spreads and see if I can find any indicators that I can use to help me decipher which is the best direction of the trade and how do I spot anomalies. So much like the short end of the Treasury curve, this still is a curve play. We must remember that. So for the last year, so currently the longer end TEDs have tracked 2's 10's Treasury curve and 5's 10's Treasury curves, which of course is inversely correlated to the direction of the outrights. We can also use the whites to greens Eurodollar curve and reds to golds or reds to blues Eurodollar curves as well. So what I've got here is a matrix where I've got the indicators that I'm looking at. So I've got down from on the left hand side, I've got your 5-year note future, 10-year note future outrights, 2's 10's Treasury spread, 5's 10's Treasury spread, 5-year swap spread, which is the credit spread in the OTC market, and Eurodollar reds to blues spread. And then in the middle, I've got the US TED 8, which is the Eurodollar June 18 versus the 5-year. And as you can see, that the 5-year and the 10-year note are highly inversely correlated to the direction of this spread. So what we've got now, we know what size to trade and we know what the trade is. We now start to say, okay, this trade, if the 10-year note is going to be going up, I would highly expect that this ED8 versus the 5-year will be trending down. Also, you've got the 2's 10's Treasury spread, and in a minute I'll show you how to create that in Stellar, but you've got the 2's 10's Treasury spread. That's over 70% correlated positively. So if the 2's 10's Treasury spread is going up, I'd be looking to buy Eurodollar to the 5-year. Also the 5's 10's Treasury spread. So you've got a double whammy, you've got a bit of support. So you've got the outrights to help you with the direction, you've got the 2's 10's Treasury spread to help you with the direction, and then you've got the 5's 10's Treasury spread just to help you. It's highly correlated. So if 5's 10's Treasury spread is going up, you would expect the ED8 versus the 5-year to be going up. Now, I put in the 5-year swap spread. The 5-year swap spread is the actual OTC product that prices a 5-year interest rate swap versus a 5-year government bond. Now, it is important because every now and then you will have a credit event, like you saw when we had those rumours about Deutsche Bank a few Mondays ago, and Euribor curve and sterling curves flatten very aggressively. But generally, these keep stable, right? But I will give you the indicators for that later on. We also can look at the ED Reds Blues. It's 81% positively correlated. So you might look at that. You might look at that list and say, well, actually, the most important indicators that I want to look at are the Reds Blues or the 5/10s Treasury spread to the direction of the ED8 versus the 5-year. And you know what? You wouldn't be far from having a perfect indicator. So again, what is driving? What are the indicators? So US swap spreads, as I had on the previous slide, from the second from the bottom, are basically the credit premium or discount between the two debt instruments that we're trading. So it's always there. Thankfully, credit events are few and far between, exception of the previous Monday when the Deutsche Bank story and the Euribor and sterling flattened and got sold off very aggressively. To monitor these, we can pull these up on the Office CQGs. So for instance, if you look here, if you want to look at the 5-year swap spread, under US swap spreads, you go type in TUS 05SP, enter, and that will give you the 5-year swap spread. I like to look at the 2, 5 and 10 year as a whole. You can also look at European swap spreads as well, because if in Europe, like it was a European thing when Deutsche Bank had the issues a few Mondays ago, you will have you will have it where if Europe sneezes, has a flu and sneezes, the US will catch that. So be mindful of looking at European and US swap spreads. So this is a typical setup. This would be the setup that I would have, right, on Stellar. So in my price viewer, I load in all the products that I'm going to look at. Sometimes I'm looking at one more than others, but as you can see, I've created 3 spreads, and I'll show you in the next few slides how to create them. So I've got the actual ED8 versus 5-year. That's a synthetic spread. So you create that in Stellar. You've got the 2/10s Treasury spread. I've created that as a synthetic spread. And then at the bottom, you've got the Reds Blues synthetic spread. I like to look at things in price, okay, because it's easier to track. Now, the US exchanges have a legacy products where they look at everything in net changes. There are actually live trading markets that you can look at on an intraday basis that track the 2/10. So in the US on the CME, there is a 2-year, 10-year intra US Treasury spread that you can actually trade as a spread. So if you overlaid that 2-year note versus 10-year IPS over the top of our synthetically created UST 2/10 spread, because we're using the same ratio as the exchange, they would look the same. But what it is on this example, that's just the net change from the previous settlement. So these are the products I look at. I've also put on there the 10-year Treasury note future, because obviously that's going to help me with the direction. So obviously, what I've got up on the top is a chart. I've created my chart. You know that if you put up a chart within the first few hours, you'll only get a certain amount of data. So make sure you keep your charts open. So then from left to right, or actually right in the middle of the Stellar ladders, what I've got the ED8 5-year. Now, that's the synthetic spread. We will actually be trading this via the 2 outrights, but that's to show you where the price is. Either side, to the left, I've got the June 18, which is the Eurodollar leg. To the right, I've got the 5-year Treasury note. To the right of the 5-year Treasury note, I've got the 10-year note future. So all of a sudden, I'm building what are the key things I'm looking at. Then to the left of the Eurodollar leg, June 18, I've got the 2-year 2/10s Treasury spread, synthetic. And then to the left of that, I've got the Reds Blues Treasuries, the Reds Blues Eurodollar spread, synthetic. Now, what we got here is, so we're actually trading the Eurodollar June 18 to Eurodollar to the 5-year note future. But what we've got, as I go through how to set up and do the trade, these are the ladders that you will need to put on this trade, okay? So how do I construct these? I know you know how to construct synthetics in Stellar, but what I've got here is I've listed each of the 3 synthetics that you will need and the products and how to load them in, and then they will look exactly like the previous slide. So what's driving the longer end spreads? US swap spreads. I talked about the TUS 05SP, which is the 5-year swap spread, which is the difference in interest rate that banks would have to pay to that of the federal government. We can load that into CQG. Normally, this is very benign and very flat, and it doesn't really impact our curves. Once it starts, so with that in mind, we generally try and just give that one as it stays as a standard and doesn't really impact your trade, right? So most important things, in my opinion, are the interest rate curves. So what I look at are these. I look at the US Treasury's 2s 10s futures curve and the US Treasury's 5s 10s futures curve. These are going to be highly positive to the direction of our spread. The Eurodollar whites to greens, the reds to blues or reds to golds, they're highly positive to the direction of our spreads. For those of you who have access on CQG, you can also track US cash bond curves. You can track the 2s 10s 5s 10s curves on there. And if you've got access to Tulloch swap marker on CQG, you can look at the 2s 10s 5s 10s interest rate swap curve, which are very, very similar to the Eurodollar curves. These are all highly positive. I've given you an example of how to load that spread into CQG at the bottom. These are all highly positive trades. I wouldn't even think about trading this trade without looking at these curves. This is a curve trade. Then, of course, what can also give you is the real sentiment, the real short-term sentiment, and that would, of course, come from the Treasury futures outrights. So I'm looking at the 5, obviously I'm looking at the 5-year because it's one of the legs, but I'm looking at the 10-year Treasury futures. I'm probably looking at the S&P, and if I'm in the European session, I'm probably looking at some of the leading European equity indexes like the DAX and the CAC. So these are the key products that I'm going to be looking at, going to help me decide whether I need to go long or short. Now, this is how my CQG would look. Now, you can replicate most of this in Stellar, and I would, suggest that you should do that. So, but this is my CQG setup. What I've got is on the top left, I've got my synthetic Eurodollar June 18 to 5-year as a spread. Below that, I've got the reds to blues as a spread, 2s 10s as a spread. Now at the top, I've got the inverse of the 5-year future and the inverse of the 10-year future. Why have I got inverse is because I know it's inversely correlated, but what I've done is so that when I'm looking visually at these products with the actual Bollinger Bands and some of the statistical tools that I'm using here, I can actually see visually. Okay, I can see that in the 10-year inverse from yesterday's settlement, it's gone up. So that's why it's just a little trick. And on the bottom, you've got the 5-year credit spread, as you can see, relatively unchanged. So what I do here, basically how to begin to look for a trade, right? So what I do is I pick the last most liquid point in the US Treasury curve and Eurodollar curve where there's most participants and from the previous day. So actually, I've always picked the 8 p.m. London time, okay? So what I do, you don't have to be there at the office, but what you can do is on your chart, and what I've done is use global cursors. I've noted down where at 8 o'clock, what was 8 o'clock, then I've noted down with the purple line going across where the actual price of the spread was at 8 o'clock. And I've done that on each of the highly correlated products. Now, if you go credit spread, I start with the credit spread. Credit spread is basically exactly the same level it was at 8 o'clock. But I'm going to look at my Eurodollar 8 to the 5-year, my synthetic. It was 275.067 last night. Now it's trading a little bit higher at 08, right? So it's higher. It's been trading 10s. Now I look at my indicators. Where are the key indicators? If I look at the reds blues on the 15 minute, overnight, or last night, was trading 1.6, which is the second one down on the left, was trading 1.674. Now it's actually 1.722, so it's higher. Let's look at the 2s, 10s. It was trading 150s, the bottom left one, 156.27. It's now higher, 157.11. Same with the 10-year and the 5-year, although these are inverse, they're both higher than, on the inverse, higher than they were. This is telling me that if I get the opportunity, this is, so let's say it's 7 o'clock London when you just come in. If I get the opportunity, I'm going to look to, and all those other indicators stay where they are, I'm going to look to be buying 275, 05, 06 level in the Eurodollars versus the 5-year. Simple trade, and you've got a very high probability of making money. Now, what I would do is I'd be holding that all the while this setup is still there. So essentially you're ticking boxes. So now you've ticked all the boxes to buy. All of a sudden what you would do is, if these indicators start to turn and tell you basically that you probably want to be selling, then you want to maybe exit your trade. But if you've come in at 7 a.m. London and you've used this technique, you should have captured enough edge that even if the indicators turn to start saying you need to be, it's starting to turn bearish, you should have captured enough edge that you shouldn't lose any money, and you may even still be able to take a little bit of profit out of the trade. So this is the 8 p.m. close. I like this. Even referring to, maybe I use a 5 p.m. close for European products, but for this type of close is really important. So remember, to try and use this technique, this is where these products were, and this is where they are. How's the product that I'm looking at, and is it a buy or sell? So lastly, but not least, is what are where the best opportunities, right? So I think this is a very interesting trade, in such that there are lots of opportunities during the day. Now, the first point will be the Asia close and European open. Now, Asian traders, I'm not saying they're bad traders, but what they do is they're more focused on, there's still a legacy of the big players. What they would do is they will still hand their spread orders, and they still will leave that liquidity and pass it over to their New York and London desk for when US get in, okay? So what they do is they generally don't trade. So they do trade, but they're not so active as they are within the US session. So what happens is there's still, the Far East are very big holders of US Treasuries, right? So when you get these big players managing their US Treasury exposure during the Asian session, what you get is major distortion of the spreads, because you have big orders in a not so liquid market, which then, of course, and not so many spreaders as there are in London and the US, all that equates to distortion in the curve. Now, I think if you get in at 7 or 8 o'clock London time, you're going to be able to take advantage of those opportunities. Now, we've been witnessing this for the last few months in some of the synthetic spreads that we've been trading. So I think that's a great starting point. Where was it last night? Where are my indicators? Is there a good opportunity to trade? Next would be key economic data. And I'm going to break that down into two. So the first will be non-US domestic data, right? So what I'll be looking at is big European, UK data points like UK CPI in Europe, where you're going to be able to, where you're going to see big moves in European fixed income distort the US curve away from where it should be. And these moves may be more subtle than what you would get over in the Asian closed European open, but you're still going to get opportunities to put trades on. Now, I think probably as good as the Asian trading session will be US economic data. Now, I'm not talking about, get your scalping hat on and be ready to hit the market as it's moving. Because I used to work at one of the ultra high frequency trading shops. One of the works that I did with them was where you would take a product, you would analyze all the historical data, how that product traded on a given economic piece of data. So let's say US CPI is expected 1, comes in 0.8. If you had that percentage miss, how much did the Treasury futures rally? And then over what time? How much volume was there? And then you do it again for a 0.7 or a 0.9 on the number. So it was all preset. So, but the funny thing is, you're in at 1:30 London time and you're out 1:30 between 25 and 30 seconds. Now, what happens is it's just almost impossible to spread everything, right? So what happens in that big rush of flow, you get big distortions in the curves, right? So, and what can happen if the smart ones can say, right, I know that 2s, 10s, or the Eurodollar to the 5-year spread that we're trading should rally if the futures got sold off hard. But what can happen is the high frequency traders can sell the market really hard on the number, buy it, and they buy it all the way back to the baseline time before the number. Yet, when you think about it, at 1:29 and 59 seconds, you didn't know that there was a really good piece of economic data. So they will push the market down, and then to scramble, they will take profit. And then what will happen is you'll get the opportunity, as long as you preset and think about your trade, to be able to put on some fantastic levels. Thank you very much.